Hello. This month I want to talk about some of the things that happen within a portfolio, I guess behind the scenes, that are very important to risk and return, but are pretty much invisible to most investors. I want to sort of uncover the areas that we look at as fund managers and what we're looking at in particular right now. So if we looked at a very high level at what makes investments go up and down, broadly speaking, I think there are three main factors. One is growth, how much you'd expect earnings or income from that investment to go up over a long period of time. The second one is momentum, which I'll explain in a second. Then the third one is relative valuation. So by growth, what I mean is if you're able to predict accurately which type of investments are going to produce the highest growth over the next 20, 30, 100 years, you will almost certainly perform better in those investments than you will in ones which have lower growth. So if, as an example, if we thought 100 years ago, if you'd invested in the US stock market, you would have made a lot more money than if you'd invested in the Argentinian stock market. Now, 100 years ago, actually, Argentina was doing very well as a country. It's just the last 100 years has actually been very disappointing from that standpoint. Now, the challenge 100 years ago, of course, will be to have predicted that. Now, more often than not, people are quite bad at predicting long-term trends like that. A great example being the Japanese stock market in the 1980s, which is still not back to the level it reached at the end of that decade. So I would say you could be confident you'll make money if you're able to predict long-term growth trends. I would just, in my experience, I think it's very difficult to do. The second thing that we look at is momentum. So momentum basically very simply means if an investment tends to have been going up, in the next period, it's likely to continue going up. And if it tends to have been going down, in the next period it's likely to continue going down. Now, this might sound spurious, but it is a very real thing, and it's definitely something that you can use to make money in your portfolio. There are very smart people and whole funds who just do this. So we do incorporate it in our investment philosophy, and it stops us from being too aggressive, getting in and out of things based on trying to pick the top or pick the bottom in investments. Because we know from experience, again, that is quite difficult to do and quite risky. I would just say that in the long term, it's harder to produce sustainable returns using this, and it's better to use momentum as something that you use to control the third factor I'm going to talk about, which is relative valuation. So relative valuation sounds like jargon, I know, but what it means is what price are you paying for an investment compared to its history? So what multiple of profit are you paying to get exposure to this stock market compared to history? Or what yield are you getting from this investment if it's a bond compared to history? Now, the reason I like this as a measure is it's very predictive for future returns. So if you buy stock markets when they're cheap on a historical basis, and you look at all the periods when you could have done that, you make very high returns in the future. But vice versa, when people buy stock markets that are very expensive, they make very poor returns. So it's an excellent predictor. I would just say that momentum and relative valuation quite often tend to be giving you opposite signals. So the job as a fund manager is to balance them and make sure that we control risk at all times, but we position portfolios to have the highest return with the least risk. Before I finish, I'll just flag up two areas today that are flashing red for us right now and that are important to take account of in portfolios. One is the difference within stock markets between cyclical, or what's called value shares, which can tend to be your old-fashioned boring companies, and versus growth or quality companies, which are the highest growth and the highest valued companies within the stock market. Now, you can actually track the relative valuation of these two types of companies over history, and I can tell you the gap's never been bigger than it is today. And the relationship between them is, in my view, highly predictable over time. So I would say with some confidence that I strongly believe that in the next 5 to 10 years, value or cyclical companies are going to outperform quality and growth by a long way. And this is something that is important in terms of risk control as well as generating returns. The second thing I want to point out is within the bond part of the portfolio. central banks, as I'm sure you're all aware, are very active. There's been huge support before COVID even, but after COVID there's been absolutely huge support. And it's led to a wall of money entering into the bond market in certain areas. And what we've seen is a massive reduction in the extra income investors are demanding to hold corporate bonds or high yield or junk bonds. And actually they're right in, compared to government bonds, the difference is right at the very bottom end of the historical norms. Now, in the past, every time we've entered this kind of period, at some point in the next few years, we've seen a major return of risk and concern, and the price of high yield bonds and corporate bonds has lagged government bonds quite considerably. And again, I think that's likely to happen in the next few years. So if you've got any questions about that in particular or these styles of investing, please get in contact. We'd love to talk to you about it. Before I finish, I just want to remind you we are an investments business. So as with anything in investments, you must remember your capital is at risk. And the last thing is, if you do like what we talk about here, please make sure you follow us and subscribe on YouTube. Thank you.